Welcome to this week's video. This week we're going to talk about the balance sheet. Basically, we're going to talk about how to read it and how to use it in your business. So if I were to come to your business and I got out my camera and I took a snapshot of your accounting, I would get your balance sheet. And that's exactly what a balance sheet is. It's a snapshot at a point in time of what your business looks like. So let's get into it. Basically, when you look at accounting in a nutshell, it always comes down to this very basic equation. That equation is your assets equals your liabilities plus your equity. Think of it like this. If you own a home, your home is worth something, and that value that it's worth is an asset. Then you look at, okay, well, how much do I owe on that home? That would be your total liabilities. And the difference, the delta being, if I owed $500,000 on a $750,000 home, I have equity of $250,000. And that's basically what a balance sheet is in your business. So let's go through the components of what a balance sheet would look like. First, you start with your total assets. This is your home in my analogy earlier. What you would do is you would look at and you would break down your assets into two main sections. One is going to be your current assets, and the other one's going to be your long-term assets. What that really means is that my current assets are anything that I can turn into cash within a 12-month period. And think of it like cash. That's already cash. But think of it like inventory. I'm going to sell that inventory within a year. That would be a current asset. A receivable, where customers owe you money. They're generally going to pay you within a very short period of time, and hopefully that's less than 1 year. So that would be your current assets. Your long-term assets are going to be things like equipment, things that are generally going to last over a period of time. It's also going to be things like intangibles, like you might have for your business, like a patent, for example. Or it could be like a deposit that you made on the office or the space that you're renting. That's a 5-year lease. So those are your assets. Then now we're going to start looking at the other side, which we'll start with current liabilities. This is kind of just the opposite of your current assets. These are going to be liabilities that you need to pay within 12 months. That's going to be like your accounts payable that you pay to your vendors. You usually pay that in less than 12 months. It's going to be things like sales tax. It's also going to be the short-term portion of your debt, meaning how much of my debt at any point in time am I going to have to pay over the next 12 months. You need to break that down that you may have in your business. And so that's what's going to be in current liabilities. So long-term liabilities is, again, that's kind of the opposite of long-term assets. These are things that are going to be paid over a longer period of time, such as debt. It's the long-term portion of debt. What portion of my debt am I going to pay 12 months and later versus what I mentioned before is 12 months and earlier in your current liabilities. Now we're going to start looking at equity. We're going to look at the first part is going to be owner's investment, the money that you put into the business, less what you've taken out of the business, not in salary, but what you've taken out in distributions or return of that capital to you, or return of the earnings that you've accumulated in your business, which is retained earnings. Retained earnings are going to be the accumulation of earnings since day one of your business. And that's basically what the balance sheet is. But let me talk about something that is a little bit of a method. It's two separate methods of recording transactions in your business. And that's called the cash basis versus the accrual basis. And the reason why I bring that up is because in your balance sheet, I mentioned that you have current liabilities, and one of them is accounts payable. And another one is going to be like sales tax. Well, those liabilities, and on the other side, in the current assets, receivables, you haven't exchanged cash yet. And so on a cash basis, you record those transactions when you actually the cash goes out the door or the cash comes in the door. Versus the accrual basis, you record the transactions based on when you've earned that money or when you've incurred an obligation. And so the cash basis, it may not necessarily reflect, well, it won't reflect the period of when that cash comes in versus when the cash comes out. So it doesn't distort the financial statements, but it doesn't necessarily give you a complete picture of a snapshot in time. You may look at your balance sheet, and in that point in time you have X amount of cash, but really you have to pay some of that money out. So you don't get a necessarily accurate balance sheet. On an accrual basis, you would. So you would be able to say, okay, well, this is the cash I have, these are the receivables I have, these are the payables I have. So I can get a good picture of where I'm at from a cash in, cash out basis in the business and the equity that I have in the business. So you kind of have to determine, do I want to use cash basis or do I want to use accrual basis in the financials? And it's really going to come down to all the timing that is in your business, when the cash goes in and when the cash comes out. If they're pretty much always going to be the same, then cash basis may be fine. If they're going to be different, then you got to start looking at accrual basis. And the third one, which I don't have on the slide here, that I would call hybrid method, would be is maybe some things I do on a cash basis, some things I do on an accrual basis, because I want to make things efficient and I don't want to focus on things that are small, that don't really matter that much in the business, that I can just use cash basis, versus things that are highly impactful for my business and my numbers, such as like payroll, for example. Payroll is going to have a timing difference, so you might want to use accrual basis for that. So let me show you an example. This is an example of a balance sheet. This is an auto repair shop. We'll just say, for example, you own an auto repair shop, and this is your balance sheet. If you look at your balance sheet, you can see your current assets, which we talked about, your fixed assets, your equipment, and your total assets. Then you break it down, your liabilities. There's my current liabilities, here's my total liabilities, and my equity. And as you can see, that, except in this case I'm off by $1, but you can see that the total assets equal the total liabilities plus your equity, which is good. And so now you're thinking, well, this is great, but this tells me nothing. Well, this is where you take your numbers and you look at the trends and you break it down. So let's think about it as an owner of this business. What are some of the things that you would want to know each month or each period to review your financials? Well, the first thing is, I want to know, do I have the ability to pay my liabilities? Am I doing okay on my current assets and my current liabilities, such that I don't have to worry over the next 12 months? Am I going to be able to cover that? And that would be your ability to pay your current liabilities. In this case, you want it to be above 1. And what that is I'm looking at my current assets, 66,586 in this case, and my current liabilities. Remember, this is what I'm going to pay in the next 12 months. This is what I'm going to get into cash in the next 12 months. So I can see that that's greater, which is awesome. That's exactly what you want. And that's what this ratio is showing. And also the trend is showing an increase, which is even better. So this I'm pretty comfortable with, that I got the ability to cover my current liabilities. Now, how about debt? I got debt in my books. How am I doing on debt and being able to pay that down? Well, I want to look at with my income that I have and the debt that I owe in the next 12 months compared with my income. And if I look at it, it's above 1, which is good. So this is showing me that I'm okay on the debt side. I'm generating enough income in order to be able to pay all my bills and including pay my debt. And trend-wise, it's declining a little bit. It's actually declining. It actually increased and went back down. So something's going on there. I suspect it's related to income. So that's something you'd have to maybe think about or look into, or maybe you're fairly comfortable with these numbers. The other is that, you know what? I may want to expand my business. Do I have the ability to do that? If I give this balance sheet to the bank, are they going to say yay or nay on being able to help me fund buying more equipment or expand in another location? Well, we could use the debt to equity ratio, which is exactly what the banks use. They're going to look at, if I loan this company business or money and I look at the equity they have, I want to make sure that the owner has skin in the game more so than the bank. And in this case, having a ratio less than 1, which would be your debt divided by your equity, would give the bank comfort that, yeah, there's room to expand, or possibly to expand. They'll look at other things, but this is one thing that they're going to look at. So as you can see, you can look at the trends for your debt to see where you're at. And then ultimately, with the business, I want to make sure that if I put my money in the stock market, I would earn less than what I earn in my business. In other words, I'm investing in the business, or I'm investing in myself, and I want to get a return on that investment. And I want to get a return on that investment that is greater than what I could get from if I invested in something else. So I want to look at what that is. And as you can see here, the return on investment is 31%. It went up and went back down, and again, that's something that you may want to look at the trend here. But ultimately, if I were to put money into the stock market, I probably would earn, over the next 30 years, on average, it's been somewhere around 10-12%. So I'm doing quite well, because I'm doubling my money if I had just put my money into the stock market and didn't have my business. So return on investment, you want to look at that, make sure that trend makes sense. So ultimately, the balance sheet is very powerful. It's something that you should be analyzing on a monthly basis and taking a look at. You want to look at the things in the balance sheet that are important to you and answer questions that you may have about your business. And that snapshot of your balance sheet is going to help you achieve that. It's going to identify areas that you may need to look into more. It's going to give you comfort that you're actually improving or doing well in certain areas, and you may not need to look in that area, but it's going to be able to tell you that. It's going to be important for capital. If you want to go to a bank, they're going to ask you for a balance sheet, and they're most likely going to want you to be on the accrual basis, or they're going to look at it that way. So it's very important for to have that as a tool in your business. Also, you got to have good accounting. You got to make sure that you're recording the transactions. You got to make sure these numbers make sense. You got to make sure that they're in the right buckets, meaning that the current liabilities is the current liabilities, long-term liability is long-term liability, and same thing on the asset side. So you want to look at that. So that's all I got for you. If you like this video, it would be awesome if you hit that thumbs up and subscribe to future videos, and I will see you on the next one.